So today we're talking about premium finance with one of my good friends, Dan Wachs of Perpetual Wealth Management.
Thanks for having me, Matt.
Absolutely. Dan and I have known each other for a while now, and we've done several premium finance deals together, and I thought it would be an awesome opportunity to get him onto the channel and just ask him some general questions about premium finance, what it is, who it's a fit for, and really just how it works. So Dan, in your own words, what is just the basic structure of premium finance with life insurance?
It's a good question because I think people think of it and they think it's very complicated. But in reality, Matt, it's really just a way for high net worth people to fund their insurance policies. But instead of paying out of pocket, what they're doing is actually going to a third-party lender to pay those premiums for them while they're able then to keep their money invested in their investments, in their business, other things. So it's just a way to utilize other people's money to fund an insurance policy.
So what type of person would this be a fit for in terms of using other people's money, as you put it, financing your policy from a bank? Mm-hmm. Who is this a fit for, and what type of person is it attractive to?
Really good question. I think that it's a fit for probably less than 2% of the population. And what I mean by that is that, so it is a limited use. I mean, because people have to qualify two ways, medically and financially. And what I mean by financially, that's the biggest thing. The net worth usually wants to be around $5 million or above at a minimum. They have good income, 250 or higher. And really that type of client is one that you'd say is choosing this strategy to do the financing through a lender, but is the person that's capable of writing the premium check for the premium amount, but they're choosing a different way to fund the policy. So limited application, 2% of population, you have a high net worth type of situation. And that can be, a lot of them are business owners, doctors, attorneys, professional athletes, but those are the people that are going to be the ones that qualify for this strategy.
So we're talking high net worth,
correct?
High income, and I would assume that there's an element of probably needing some liquid collateral or being relatively liquid to make the strategy easier to work, because there is going to be a collateral component in most cases as it results or as it pertains to premium finance. So what type of liquidity would we be looking for most types of applications?
Yeah, so I think that the critical thing with financing, and is usually the barrier to people doing it, is the fact that in the early years of an insurance transaction, the cash value is not enough to sustain what is owed to the bank as what's been borrowed. So in early years, we have a component that we need some outside collateral in the form of investments, cash. I use with real estate guys, I use letters of credit that are a way that they can post that without using their own assets. But, it's a really good point, because these people they can't have no liquidity in order to do it, because the collateral is needed. And what's nice about that is if I'm doing a real estate transaction, I'm supposed to put 20% down to buy a property, right?
Sure.
So that's putting that money down. This is kind of putting the money on the side, and they're going to get that return to them, and the policy is going to be able to grow and then sustain the deal for them. But yeah, so there is liquidity needed, and that really is going to depend on the size of how much they're borrowing and how much is available. And the way the lenders do it is they say, okay, if you were to cash out the policy, how much is available? And that difference is what we need to post as collateral.
Understood. And so with these policies being life insurance policies and having surrender values in those early years, that's where that kind of, we would call it gap collateral.
Correct.
That's where that comes into play. The value of the total loan minus the value of the policy after surrender charges, because that's how the bank is going to look at the value of the policy after surrender charges.
That is correct.
And whatever's needed there would be needed as collateral. So, okay. Well, what are the risks involved with premium finance? It seems to me that there's a lot of variables that are involved over and above just your standard, life insurance policy purchase. So this wouldn't be, market performance. That's going to apply to any type of policy you want to buy. But specifically with premium finance, what are the risks that are involved?
I think because you're using a third-party lender and it is borrowing money. So number one is that the lender has to be paid back.
Okay.
So at some point in time, so this is not a short-term transaction. We're looking at something that's going to be 12, 13, 15 years of holding it. So the risks that come into mind are interest rate risk, as we're seeing right now. Interest rates going up 13 times in 1 year, not normal, never happened before. But that's the risk. That's one risk that people realized in these strategies. So being able to design something that's flexible to work around that is super important. The second thing is policy performance. Does the policy have strategies internally that can earn a decent rate of return that we can earn and be able to pay the lender back? That's super important. So those two risks, I think, client situation, is what they're doing work-wise, earnings-wise, is that pretty stable? I mean,
Right.
we don't want to have someone that had a home run thing happen and then this is a good strategy for them, because we have to have them to be able to be pretty stable in order to do it. But then for me personally is when I designing it to say, okay, this is a part of their overall plan, not, hey, this is the only strategy they're going to do, so let's put all their money into it. I mean, that's a big risk. And that's more of not a client risk, that's a risk of who you're working with. Because I've seen some crazy designs that, I'm not sure that the person could have really sustained it or afforded it.
Yep.
So
what I'm hearing you say, the risks would be in the early years, number one, there's not much liquidity and it's a long-term transaction.
Correct.
10 to 15 years. Because of that, you're going to need to have stable income, stable assets, because it isn't a short-term play.
Right.
So this is not something that you get in and you get out in year 3 or year 4 or year 5.
Right.
And then, of course, the structure of the policy matters. The company that you're working with matters. The lender matters.
Let me touch on that, Matt, because I think that's important, because there's a lot of different lenders that say, we'll do this premium financing. I like to work with lenders that know how to do this, that have been doing it for a while, that have no prepayment penalties, have no origination fees, or very limited on those. I've seen lenders that work in the private equity markets that are trying to raise capital to fund their strategies. That makes me nervous. So I think that you have to have solid players, and it's not like you go down to your bank in your town and say, I want to do premium financing, and the lender's going to know what that means. Right. So we really want to work with lenders that understand how insurance policies work outside of of lending us the money. But I want banks that have a lot of capital, and I'm not worrying about if they're going to fund my transactions, because that was another risk. I've seen lenders get out of the market. I've seen lenders that were offering fixed rates, and when interest rates go up, that these rates, when they borrow money from the Fed to fund these deals, they're borrowing at a higher cost than what the client's paying. So there's a lot to that, but so we have to really understand the lenders we're working with. So we have a handful of them. And depending on what the client needs, that's when we're really going to decide, who we're working with, what lender. But mainly, they have to be stable as a lender.
Yep. All right, let's talk about age of clientele. Does it matter how old you are? What's more important, how old you are or your time horizon for the transaction?
That's a super good question. Obviously, in insurance, the younger someone is, the better.
Right.
But how many people actually, when they're younger, are worth $5 million?
Right.
So that's very limited. But of course, the younger someone is, and really the value, Matt, is when a person's younger, it's really, they get more out of it from, they're going to live longer, so they have more time to enjoy the benefits of what we're doing, whether that's tax-free income or estate planning, growing the death benefit, But I can make the numbers work for someone who's, 35, someone who's 55. It's just that 55-year-old's probably going to pass on before the 35-year-old, and then they're not going to have the same amount of benefits. But obviously, the older someone gets, it's sometimes really difficult to make the numbers work internally for the policy and feel confident that I'm going to be able to pay the bank back. and still provide these benefits for the clients. So, and because insurance is based on, if they're older, their internal costs are going to be more expensive, right? I mean, so that's the problem.
Is there a point at which it wouldn't work from an age standpoint?
Yeah, and it really is what I do personally is if a person has an advisor, I'll run the numbers based on my models for that person. And if I can get the numbers to work, I may proceed, but a lot of my competitors will proceed no matter what.
No matter what.
No matter what happens. So, if I don't feel I can pay the lender back, I'm probably walking away from the structure. And that usually anytime in your high 60s, 70s year old, it gets a little bit more challenging.
Yeah. 65 plus is typically what I've seen where it starts to get pretty difficult.
Challenging.
Very challenging.
Now, let me make one point is that it's challenging if I'm taking the money out of the policy to pay the lender back.
Right.
Now, if they have other strategies, grant or trust that are going to fund some of this stuff, or real estate sales of real estate, and I can pay the lender back, then it could work, right?
Sure.
But the client in advance, we have to be okay with that's what we're going to do.
Yeah, need to know that up front.
We need to know, we know that that's going to be part of the plan when that happens. Then it could work.
Yeah. So if the client has dollars outside of the insurance transaction that they are comfortable with using to help the policy pay the lender back at some point, it can work at older ages, but obviously that's something that needs to be worked through before you get into the transaction itself.
Right.
Is that what you're saying?
Yeah, and sometimes, Matt, I mean, the ultimate exit strategy is going to be the passing of the client, right? I mean, and then it works.
Right.
It works. It might not be as great, but the point is that I don't know when that's going to happen, and I don't want to rely on it. So when I say the numbers probably don't work, it's because of the fact that I'm trying to take the money out of the policy to pay the bank back.
Understood. So if I'm just recapping, premium finance in general, we're looking for about 2% of the population this is going to qualify for in terms of a net worth standpoint, 5 million plus, in terms of an income standpoint, 250 plus. You have to be young enough to have time to pay the lender back. It's not a short-term transaction. Yep. We're talking 10, maybe 15, 20 years that you're in this policy. And so I would say that this is probably one of the worst short-term vehicles in the world. It's one of the worst short-term. Unless you die. Yeah. That's right. But nobody's getting into this to die.
Yeah, then it's the greatest.
Greatest short-term vehicle if you die.
Yeah.
Worst short-term vehicle if you live. Okay.
That's true.
But you're in it for the long haul, and you got to have a stable source of income, stable source of assets. You need some liquid collateral. You need time to make it work. And if all those things line up, premium finance can be a beautiful strategy, but there are risks involved. And the risks we discuss would be the risk of the lender maybe doing something different in the future, or not being able to borrow at rates they said they could borrow at. Policy performance risk is one. How the policy is designed is another one. All those should be carefully considered. So I would just say, if you are considering a premium finance policy, or you have a premium finance design, you should have an expert look that over, because this can be one of the best things you ever get into. And it can also be one of the worst things you ever get into if it's done poorly. Dan and I are both experts in this space. And so if you would like a second opinion, you should reach out to us. You can go to my website, leveragedwm.com. Up at the top, you'll see Contact Us. You can book a meeting with us, and we can chat about whatever it is that you may be considering in the premium finance realm. And Dan, go ahead and give a shout out to your website as well so people can find you.
It's perpetualwm.com. So Perpetual Wealth Management, perpetualwm.com.
Perfect.
Thanks, man.
Absolutely. Yeah. We'll be back with more on premium finance and diving into some of the specifics about where these policies really may fit with some specific applications. Until next time, take care.